Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Charles Hugh Smith, author, leading global finance blogger, and America's philosopher, we call him. He's the author of 9 books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, Liberation, A Model for Positive Change, and the Nearly Free University in the Emerging Economy. His blog of twominds.com has logged over 55 million page views, much more than that now, and is number 7 on CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. I hope I can live up to that glowing introduction.
Oh, you always do. And we'll also make reference to your new book as well towards the end.
Great.
Today's discussion, I thought we'd look at financial repression, how it's likely to be here to stay for a long time. And it represents the tools of basically trying to keep the status quo going. And we can explore what the effects are of financial oppression on the economy, on the financial markets, what the potential endgame is, and what it all means for everybody and for investors in the financial markets. Your initial comments?
Well, Richard, you have a nice chart here that I thought maybe you could introduce the basic moving parts of financial repression for listeners that aren't that familiar with what that actually means.
Sure, let's take a look at that. So this is a chart that is on our website that essentially gives the insight of what is financial repression, why it is happening, and why it is happening for the long term. So there's nothing to do with any conspiracy theory here. It's just actually the result of good intentions by government policies and programs. So if you look at the chart, it's a bunch of concentric squares, essentially. And we have on the outer layer is the idea of controlling and reducing the burden of government debt. So we have this unsustainable government debt, unsustainable government pensions, and it's all about being able to control and reduce that, those challenges. Those challenges get translated into a number of goals that are essentially in place, and that is to maintain confidence in the government, minimizing the risk of a derivatives meltdown. So we have these trillions of notional derivatives in interest rate swaps and other types of derivatives that, pose a threat to not only the financial markets, but the entire financial system and global economy. So there's the interest in the goal to minimize the risk of a derivatives meltdown. We also have minimizing the risk of financial and economic crises. So what happened in 2008, how can we minimize the risk of that happening again? And then just overall maintaining economic growth. So those are the actual goals that drive what's happening. And as we move to the center of these concentric circles, we look at what's happening from actually 4 pillars of financial repression. So these good intention policies of government and programs actually result in negative interest rates, obfuscation of data, such as inflation, ring fencing type of regulations, and inflation, forced inflation. So if you look at the chart, it'll describe those 4 pillars and examples of that. For example, like on ring fencing regulations, we have Dodd-Frank Act, Basel Accord, FATCA, GATCA, different types of other regulations that are resulting, from trying to reach these goals as we just mentioned earlier. And then there's inflation, of course. The idea of having a steady rate of inflation for so many years can reduce the burden of debt. And then we have negative interest rates, inflation adjusted in terms of nominal rates minus inflation could be the view now in terms of having negative real interest rates, even if the nominal interest rate is not negative. And then we have obfuscation. So while the government may be calculating inflation, for example, very accurately, it may not be appropriately accurate, calculated in the sense that, what do consumers actually spend their money on? The Chapwood Index is actually perhaps the best index that can gauge that level of inflation. And it's actually indicating inflation of 8 to 10% per year happening in most North American cities. So essentially all of these pillars translate, as you can see in the core box, into investor risks. So all of this unintentionally results in risks to investors. Could be for individual investors, institutions, pension funds. And that translates to low or negative yields, wealth confiscation, loss of purchasing power. So the challenge is how to invest in those environments and in those conditions. So this is essentially the long-term view. And just wondering your thoughts on that, where we currently stand, Charles.
Right. It's a great overview, Richard. And I think how I would sort of summarize your chart here is that these are monetary policies to fix what are widely recognized as structural economic problems. And we have a few charts here that are depict those structural economic problems. One of them is wage stagnation for the bottom 60% and to some degree the bottom 80%. And this is a long-term policy. It's a problem. It's not just something that happened in the last few years or even the last decade. It actually stretches back as far as 40 years. So we're talking about 2 generations of wage stagnation for the bottom 80%. And I have a chart here that shows how the labor share of the GDP, like wages and salaries and so on, has been declining for decades as well. So that's a real problem, right? Because if consumers aren't getting more purchasing power, they're unable to support the economy, right, with additional consumption. And so what financial repression attempts to do is flood the economy with liquidity and easy credit, right, at low rates, so that consumers, corporations, and institutions are all encouraged to borrow more. And rather than actually earn more and save more, the whole idea of financial repression is just go borrow the money and then spend it today. So that's bringing demand forward as a sort of solution, what I would call a fake fix to wage stagnation. And we can see this, any kind of tricks like this, fake fixes, they don't really work for long. And so we can see that in 2 charts. One is we can see that in consumption, that this is the Fed's favorite measure of consumption, the personal consumption expenditures. It's been trending down since 2015. So, I mean, despite all the hullabaloo about what a great economy we're having, it's like, well, personal consumption's down. And we can also see it in what a lot of people call as debt saturation or debt exhaustion. And here's a chart of GDP and debt. And it took $4 in new debt to create $1 in GDP growth in 2016, and I believe that's probably accelerated, and now it takes probably $5 or $6 in new debt to create $1 in GDP. So these are so-called solutions, but they were politically expedient. In other words, nobody will contest lowering interest rates because that lowers the cost of borrowing money for everybody, right? But it actually, beneath the surface, it's concentrating wealth in the hands of those with first access to cheap credit, right? The rentier class. And this is why wage stagnation hasn't been fixed by financial repression.
Yeah, in essence, also the central bank activities on this resulting in financial repression has given a sort of bad name to capitalism, so that a lot of, as we discussed in our last program, show the many of millennials are mistakenly seeing capitalism in that light.
Right, and because I have a chart here to speak to that. I have a chart here of the Fed funds rate, and it's quite interesting to see that, as we all know, it was basically zero bound from 2009 all the way until nearly 2016, and then suddenly it's up and away. I mean, there's been 8 or more rate increases, and of course, this is not a market mechanism. Right? I mean, the market would fluctuate, and there might be a trend in the market depending on investors' risk appetite or the rise in yields and so on. But so this is a manipulated market, right? In other words, that it's suppressed to zero, and then suddenly the Fed is trying to catch up and so-called normalize rates. If you don't mind, I'd like to ask you to speak to how this idea of repressing rates to zero for the most of a decade, and then suddenly trying to normalize it in 2 years, isn't that being painted into a corner somehow, policy-wise? Because as rates go up, then suddenly the whole idea that you can just keep borrowing more at negative rates to fund future consumption, doesn't that whole idea blow up?
Yeah, I mean, not to mention the potential effects, as we mentioned earlier, on derivatives meltdown. 80% of derivatives worldwide are in the interest rate swap category, and those are dependent on what interest rates are. There've been a number of calculations with various assumptions that have shown that if we increase rates 5 to 8%, so-called normalizing interest rates, that could have disastrous effects and could trigger a derivatives meltdown. So they can only go to a certain point, and then they'll have to begin, re-liquefying the system, printing money, quantitative easing programs, and actually, for example, on the housing market in Canada, just last Friday, now the Bank of Canada has decided to print money out of thin air and essentially do a buying of mortgage bonds, do the cooling of the housing market. So it's beginning now in Canada, as well as interest rates rise, because this could affect borrowing rates, mortgage financing for the housing sector.
Right. You speak, you described how swaps and other derivatives are mostly interest rate sensitive. And isn't this one reason why we saw like a tremendous meltdown in the emerging markets, currencies, and stock markets over the last 9 months?
Yeah, exactly. So on the U.S. side, interest rates have gone up in tandem with the U.S. dollar strengthening. And given the $9 trillion in U.S. dollar denominated debt for corporate debt globally, this presents a big problem for emerging markets as they scramble to get U.S. dollars in order to pay for that. So the currencies of the local countries locally are getting weaker given a U.S. strengthening of the dollar. And so therefore it becomes more and more difficult to pay back those loans that are denominated in U.S. dollars.
Right. And Richard, let me correct me if I'm wrong here, but let me attempt an explanation for our new listeners. who may be unfamiliar with how this interest rates works with currencies and debt, is that when the Federal Reserve was very aggressive in dropping rates to zero, right, early on in 2009, 2010, well, that made the dollar drop because your currency is either supported or weakened by your interest rate, right? If a nation has a very high interest rate, that will attract capital and that will strengthen their currency. So other economies, other nations with denominated in other currencies, they could borrow cheaply in dollars. And then as the dollar dropped, then it was cheaper for them to service that debt because they could basically convert their local currencies, which were still stronger than the dollar, into dollars. And so it was actually a winning trade to borrow in dollars. But suddenly, with the Fed aggressively raising interest rates over the last 2 years, that benefit has reversed. And so now it's much more expensive to service that debt denominated in dollars because now the emerging market currencies are much weaker than the dollar. So there you have to convert your local currency into dollars. You're losing up to a third of your money right there in that conversion, and never mind the interest rate you're paying in dollars. So this is, in my view, I look at it as sort of a systems dynamic, and so I am including a chart here of how systems collapse, which speaks about buffers. And so the financial system is like an ecosystem in the sense that there's buffers, in the sense that there's always, if there's a liquidity problem, then there's usually another way you could borrow money, perhaps at a little higher interest rate to tide you over until you can refinance your debt. And these are the kinds of mechanisms that are in the financial system. But what we're talking about here with the Fed aggressively raising rates, and it's thinning all the buffers throughout the global financial system because it's making it really difficult for anybody that borrowed in dollars to refinance that debt or service that debt. And so I think we're a lot closer to defaults than most people might think, looking at the apparent stability.
Yeah, exactly. And it's not just at the private level, it's all public and private levels, sectors. To give you an example, for the province of Ontario, there's approximately a budget of $100 billion for the budget and $300 billion in overall outstanding debt. 10 billion, 10% of that budget goes to just paying the interest on the $300 billion debt. Now, this is with low interest rates. So can you imagine if interest rates normalize, that interest payment, that servicing of the debt could consume, 20, 30, even up to 50%, let's say, of the entire budget just to pay the interest on the loan. Forget about the principal. If you do the math for Ontario, it's about 9 times worse per capita than Greece. It's essentially only a matter of time before there's a crisis in Ontario. And Ontario is not the only jurisdiction. It's all over the Western world, essentially, North America, Western Europe, Japan. This is the type of situation that we're facing. So while the interest rates were very low, repressed low for a while, that allowed governments to borrow even more. But now that interest rates are creeping higher, it's becoming more and more difficult to pay the interest on the debt, to service that level of debt. So it's a sort of a quagmire lever with two parameters, the level of debt and the level of interest rates. If they're, one is high, one can be low, but if both are going high, which is sort of what we're having now, then you're in big trouble.
Wow, that's a striking set of numbers there about Ontario, and it calls to my mind the current or the recent protests in Paris, which were about fuel taxes going up, right? And while the government made some sort of politically correct noise about this was to protect the environment, blah blah blah, everybody knew that it was just to raise revenues. Tax revenues, right? Because as you say, as governments face higher borrowing costs, then their choices are rather bleak. They can either borrow more money to pay the interest on their existing debt, or they can raise taxes, or they can do both. And so now we're seeing political pushback from raising taxes just to make interest payments.
Yeah, and it could be a smattering of those factors we mentioned earlier across the board for perhaps increasing taxation rates, new taxes like wealth taxes, for example, on multiple rental properties may come into play, where those wealth taxes could be even potentially equal to property tax levels. So that would make it quite burdening for people with holding multiple rentals, for example. There could also be forced inflation, right? So that could also help from the government perspective to minimize the debt of all of that government debt by increasing the level of inflation through printing of money and all of the effects of the quantitative easing programs, as perhaps some of the excess reserves held at banks go into the real economy. It may have an increase in liquidity in the money supply. So all of these factors are happening all at once. It's different tools of financial repression that are essentially being deployed in order to keep the status quo going.
Right, and Richard, I think that our discussion over the last several months about socialism versus being an appealing option to young people who have more or less feel left out of the current economy, it was politically expedient 10 years ago to create all these extreme policies of financial repression. But what's happened is they've now the central banks have backed themselves into a corner where they really can't exit from that financial repression, because, as we're saying, as you raise interest rates, then you're pressuring government spending. You're pressuring consumers, which are holding up the economy, and you're also pressuring zombie corporations, right? Which is a term that describes corporations which need to roll over large amounts of debt and borrow more just to sustain their solvency. And I think you've covered this in other programs as well. So there's a potential for the whole corporate sector to blow up in terms of debt that can no longer be serviced to being defaulted.
Yeah, and a lot of corporations did do share buybacks by actually borrowing money at low interest rates to fuel share buybacks, resulting in an increase in the share prices. But now that interest rates are going higher, that could backfire overall on the company's bottom line. In addition, I mean, you've got it's not just in the U.S., Canada, but if you look internationally, the European Central Bank, the Bank of Japan, the same thing is happening there, perhaps even worse, where they may be the big buyer of, and in some cases the only buyer, as in Japan we've seen many times, of government bonds. So if they step away, those economies would be in big trouble.
Right, because what rational investor would buy a bond that's paying 1/10 of 1%? I mean, as you described earlier, there's a tremendous pension overhang in the Western world, in that tens of millions of people were promised pensions. And the pension funds are basically supposed to fund those pensions off of investment returns. And financial repression has dropped those to rates of return for safe investments to nearly zero, especially if we look at real rates like adjusted for inflation. Mm-hmm. And so that's pushed all these pension funds into risk assets, stocks and real estate and so on, which was far is kind of outside their comfort level in terms of low risk returns. And so again, in the context of that you described, that these tools were deployed to maintain the status quo, but they've actually increased the risk of the status quo crashing and burning.
Yeah, there's essentially no way out. As you mentioned, we've been painting ourselves into a corner. And what is the end game of all this? Is there a way that financial repression could work, or are we looking at essentially, ultimately, a crash and burn scenario to happen, where things are getting more unstable, as you mentioned, more and more debt is needed for just a smaller amount of economic activity. Eventually, this gets highly unstable and essentially unsustainable. So what do you see as the end game?
Right. It's a great question, Richard. And I think we can start with the incentives. And the problem with the core problem with financial repression is it creates extremely perverse incentives, and which you mentioned. We've talked about several of them. One of them is, as you mentioned, stock buybacks. It makes perfect sense to borrow billions of dollars like GE did to buy back your own stock and reward the insiders and shareholders when interest rates are low. And so you create these perverse incentives which are not really investing money in the real economy to create productive wealth, right? In other words, that this is just being used for stock buybacks and consumption. And so that those perverse incentives are hollowing out the real economy slowly but surely. And so I have a chart here, which is again a sort of systems dynamic called the S curve. And a lot of the financial repression that we've seen in the last decade follows this S curve. Like the initial impact of quantitative easing and lowering rates to zero was very positive, and there's kind of created a boost phase, right? Like borrowing shot up, the economy turned around, all the fears of a collapse that was looked almost guaranteed in 2008. All those fears vanished, and then Mario Draghi announced, in 2011, I think it was, that the ECB would do whatever it takes, i.e., follow the Fed in quantitative easing and financial repression. But all of these they follow an S curve where the positive consequences kind of top out, and there's no more positive consequence. And even if you increase the level of financial repression, like negative interest rates and unlimited liquidity, they no longer have a positive effect on the real economy. The effects actually start becoming negative. And I think that's the end game as I see it. Now, that we may get a slow decay, like an erosion of economic vitality, or we might, if we thin the buffers to the point where some minor crisis could collapse those, then we do get the crash and burn.
Yeah, that's what it looks like. And sorry to end on that note, but it looks like that's what's in store for us. And then, of course, there'll be a rebuilding at some point once the crash and burn happens. But that's to be seen in the distant future. But yeah, these charts are absolutely fascinating, Charles. They give the whole picture in 1,000 words. Just fascinating charts. We'll make these charts available on our website as part of the transcript, as well as incorporate the chart that Gordon T. Long and I came up with initially when we started doing this whole series on financial repression. So we'll make that all available in the transcript for this program. Charles, how can our listeners learn more about your work? And if you can mention a little bit about the new book that you've come out with.
Yeah, thank you so much, Richard. Please visit me at of2minds.com, and you can find a free PDF of the first section of my new book, which is called Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic. And as you read the free part, you'll see that what I'm really talking about is if you combine the flaws in our political system, which is pay for play, and the financial repression we talked about today, we're really facing a threat to the democratic republic of the United States and all democratic republics, whether they be Canada, France, or other European nations. And so this is a really toxic combination. So that's what my book's about. And like I said, download the first 10, thousands of words for free off my site.
Well, that sounds fascinating and well researched, thought out. Great insight, Charles, and look forward to looking at that.
Okay, well, great. Thank you so much, Richard, for having me on the program.
Great. Thank you very much, Charles.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.